Hey, good morning, options traders. And I wanted to talk a little bit about calendar spreads. It's a question I get a lot about this particular strategy because on one hand, they seem very simple. You're just buying and selling different expirations with the same strike, pretty much just taking advantage of the time decay. Now, when it comes to option strategies, there are always hidden dangers, but there are some that are particularly deceptive with calendar spreads, and here's why. So first, let's do a quick review of a calendar spread. Recall that you will be buying, let's say, a longer dated option at the money. There's different ways we could do them, but typically they are done at the money. It could be a call or a put. And then we're going to sell a shorter dated option with the same strike, again of the same type. If you bought a call, you would sell a call. If you bought a put, you would sell a put. But for this video, we are going to assume that they are the at the money options, where that strike equals the current stock price. So for instance, let's say that you buy a 90-day $100 call and you sell a 30-day $100 call against it. Well, from a risk standpoint, this is what it looks like. So you've heard me talk about in pretty much all of the videos that when we look at our risk graph, we usually get a bend at the strike. Why are we not seeing a very hard bend? Well, in a way we are, but we're also seeing these lines smooth out. We're not getting those very straight lines like we do on most of our risk graphs. And the reason is when we are dealing with strategies that have multiple expirations, such as this one, what you're looking at is at the expiration of the shorter term option. So in this example, we bought the 90-day, we sold the 30-day. This graph is 30 days later, which means that our long option now has 60 days to expiration, right? It's aged by 30 days. And the 30-day is now at expiration. It has no time left to go. So this would be the resulting risk graph. So you can see from the risk graph, we need the stock to stay reasonably still. Ideally, we'd like it to sit right there at the current stock price. But the thing to notice is that if you use longer dated calendar spreads, you are giving the stock price more time to move. So remember that there is always a bell curve over the current stock price. In this example, we're assuming it's 100. But if we used a longer dated calendar spread, we're giving that stock price more time to move. And that means that bell curve gets shorter and wider. It's just showing that we now have more ability for the stock price to rise and more ability for it to fall out here. And that's going to increase the risk of the strategy. So for this video, the question that we really want to answer is, let's say if you buy a 1-year $100 call, should you sell a 1-week option against it, the weekly? Should you sell a 1-month against it? What about a 6-month? About a 9-month? There's all kinds of combinations that you could choose. Is there an optimal way to figure out which one you should choose? And the answer is yes. Now in this video, I'm not going to get into so much the better ways to choose the strikes, these combinations, but instead to show you why you have to be careful with the longer dated ones. So to see that, we have to look a little bit about calendar pricing and therefore our option pricing. So we've talked about this before in previous videos, the square root pricing rule. And what it says is that if we have a 1-month option trading for $1, a 2-month option would be trading for about $1.41. So notice that we have twice as much time on this option, but it's not trading for twice the price. It's only $1.41. And the reason is we have to take the square root of 2. All right, so we've doubled the amount of time, or 2 times the amount of time. The square root of 2 is 1.41. And that means we're going to multiply this first option's price by 1.41, and that's where we're getting this $1.41 from. And then that same relationship follows through the entire chain. So a 3-month option would be trading for about $1.73. 4-month option would be trading for $2. This one's easier to see. We have 4 times the amount of time compared to the 1 month. The square root of 4 is 2, and therefore this 4-month option should have twice as much value as the 1 month. And here it's very easy to see that it does. It's trading for 2 instead of for 1. So that, again, that pricing relationship just continues through. So let's just use these 4 quotes here for our example. Let's say that you buy a 4-month option for 2, and you sell the 1-month option for $1. Okay, the cost to you, or what we would call the net debit, is $1. And that's because you spent 2, you collected 1, you've got $1 into the position. And this is the most you could lose. But now we're going to assume that 1 month has passed. We need to wait for this one to get to expiration. And that means that your 4-month option is now a 3-month option. And that means that its price will have moved from 2 to $1.73. This is assuming all things being equal. Volatility stays the same, stock price stays the same, which is a huge assumption, but we've got to start somewhere to see how the relationships work. But it should fall to somewhere around $1.73. Now, if that stock price is still at the money in 1 month, the 1-month option that you sold is worthless. So what happens? How much is your profit? Well, you spent $1. You could close it for $1.73, and therefore you would have a 73-cent profit. So where is this 73 cents coming from? Well, it's from the different rates of decay in these options. So notice that the option that you bought fell from 2 to $1.73. It lost 27 cents. But the option that you sold for $1 lost all of its value, right? You sold it for $1, it expires worth 0. So if you lose 27 cents, but you collect $1, there's 73 cents. And that's where that profit is coming from. But now the problem that we're trying to figure out for this video is what happens if you sell a 2-month or a 3-month or things that are much longer dated. You are sharply increasing the risk, but because of this square root pricing rule, the additional profits will be fairly small. Now they'll be a lot bigger in terms of return on investment, your ROI. But right now I'm just trying to show you that the additional profit drops dramatically. So watch this. Let's say that we buy a 4-month option, again trading for 2, but now we sell a 2-month option for $1.41. All right, so a lot of traders get attracted to this because they say, oh, I'm collecting a lot more money. I'm reducing my risk. Instead of spending 2, now I've only spent 59 cents. And in their mind, they think that this reduces the risk, and that's a misperception. Remember that when the market price falls, it's because of the increased risk. Traders are bidding the price down to account for the risk. And that's part of what you have to understand as a calendar spreader. So after 2 months, our 4-month option is now a 2-month option. It's aged by 2 months. So if these prices stay the same, it's worth $1.41. So we paid $2 for it, and it's now trading for $1.41. But the option that we sold for $1.41 is now at expiration, still at the money, so it's worthless. So now the profit is the difference between the 59 cents that we paid and the $1.41 that our long is worth, 82 cents. So notice in the previous slide we had a 73-cent profit. Now it's only 82 cents. By going out a full extra month, we have picked up 9 cents. So where is that coming from? Well, notice in the first example, our long option decayed from 2 to $1.73 or 27 cents. By holding an additional month, we go from $1.73 to $1.41. So that's 32 cents of decay, from 27 cents for the 1 month to 32. So we've only lost an extra 5 cents of decay. That doesn't sound so bad. Well, how much did we pick up in the amount that we received? Well, instead of only earning $1, we've now picked up $1.41. So we've picked up 41 cents, but we've also lost an additional 32 cents. And so that's where that 9 cents is coming from. That's why on the previous slide we had 73 cents for a max gain, and now it's 82 cents. So the point that you have to see is that as you start selling longer and longer dated options against your long position, the additional profits start to get drastically reduced. Now again, in the terms of the ROI, the return on investment, that will increase. And I'll show you some interesting relationships in a future video. But for right now, what I want you to understand is that if you buy a longer dated option to try to get away from that time decay, let's say you buy a 9-month option, consider selling the weeklies or maybe a 30-day option against it. Now, of course, keep your bearings. Don't sell it for 10 cents. But you should be selling things on the shorter end of the expiration curve. If you buy a 9-month option and you want to sell a 7-month option against it, the additional profit that you're getting is minuscule, and it's only increasing the risk. In the previous example, you only had to hold it for a month to be correct. You needed that stock price to be right there at the money 30 days from now. But if you sell a 2-month, now you need it to be at the money for 2 months in a row. You have to be correct twice. But the thing that you have to be careful of is that if you are buying a longer dated option to try to reduce that time decay, which is a good strategy for the calendar spread, let's say that you buy a 1-year option on it. That's okay. Just try to sell the weeklies or maybe a 30-day against it. But you'd like to sell on the shorter end of the expiration curve. Because if you buy, let's say, a 1-year option and sell a 9-month option against it, it might look like it's better because it's going to be a lot cheaper. That might give you the illusion that it's safer or less risky when it's really just the opposite. And the reason is you would have to be correct for all of those months in a row. And instead, you're better off to just maybe continually sell off the weekly or the monthly. So if this sounds confusing, that's actually a good thing because it shows traders that strategies aren't always as easy as they appear. There are always hidden risks and details that you have to understand in order to make the best decisions. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.